Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stocks chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So the company we're analyzing today is Fonebox Retail Ltd. The company operates a multi-brand physical retail chain, mainly selling smartphones and consumer electronics across the Gujarat region. Currently, they have a few very minimal presence in Maharashtra state, which they intend to expand in the coming year. Basically, they also provide additional credit and EMI facilities along with comprehensive after-sales services to their customers. So this is like any other retailer. And the company was established in 2021 and they acquired established retail mobile store brands called Fonebook and My Mobile. This was in 2022. This actually caused a very major jump in their revenue in the year 2022. So in 2021, they were doing around 90 lakhs of sale, and in 2022, their revenue actually jumped up to 90 due to these two acquisitions. And as of now, they are operating under three distinct brand names, which is Fonebox, My Mobile, and Fonebook. So the images are listed here. And they're operating on a pure B2C model. And their revenue is repeat, but it is also seasonal because it was driven by festivals, launches, promotional offers, and discounts. And most of these offers and discounts are more prevalent in the second half of the year, which is why their H2 tends to be more profitable. And some of their marquee brand partnerships include all the major brands which we've heard of. So Samsung, Apple, Redmi, Vivo, Nokia, Micromax, all the major brands. And even in electronics, there's Sony, Philips, JBL, all popular brands. And along with that, they also provide financing options in case someone cannot make a purchase immediately. They need some financing help. So they have tie-ups with all major Indian finance companies. So moving ahead to their business segment breakdown, their exact product contribution to revenue is not really mentioned. However, they specify that the additional services which they provide, like the insurance and the extended warranty, etc., is a more profitable component of their business. So that has higher margins. And talking about their store presence, so as of 15th November 2024, they had 169 active stores and 16 active stores in Maharashtra. And upcoming stores within up to FY25 was supposed to be 14 in Gujarat and 9 in Maharashtra. So overall, I would say by the end of FY25, they had around 200 existing stores. And talking about some of the products which they deal in, so these basically like accessories and home electronics. Coming to their management overview, so the company is led by a well-experienced team, and all of them have strong domain experience in the retail, distribution, finance, and operational industries. And they all have around 8 to 17 years of industry experience on an average, and they all hold relevant educational backgrounds as well. So that makes them well equipped to drive the company's growth. Now, coming to the industry of peer analysis, the Indian electronics market was valued at approximately 80 billion in 2024, and it is projected to reach approximately 150 by 2033. So that is a CAGR of 6.9%. And some of the key competitors include mainly larger brands like, these are all very well established, and most, I'm sure all of us have heard of them. So Reliance Digital, Chroma, Vijay Sales, these mainly operate in the larger cities and tier 1 areas. So that is some of the major competition that the company might face in case they plan to expand in the tier 1 cities. And other kind of competition is the smaller and more localized multi-brand retailers in the unorganized space. So usually the smaller stores which aren't like under proper branding, those are the competitors. And another category is directly the supply manufacturer's own flagship stores or their own website. So these are the different competitions that the company might face. And Fonebox is positioned as a small regional niche player, which is mainly catering to the localized tier 2, tier 3 kind of demand. And it is not a pan-India leader as of yet, but it is mainly focused on capital efficient expansion and on franchise based scaling. And talking about some of the trends which the industry is currently seeing, it is basically omni-channel retailing. So people are using multiple modes for purchasing. So they are using a combination of both online and offline. People usually prefer to online research online and then go and have a touch and feel of the product offline in the store. So that basically that kind of trend is going on. And other than that, there's smart home and IoT growth, EMI and financing, and technology driven inventory management. Coming to their historical performance, basically the company saw a huge growth in their revenue due to the acquisition of the two major brands which I mentioned before. So revenue jumped from 1 crore to 90 crores in FY22. And during the same period, they saw a turnaround in their profitability. So earlier they were making a huge gross margin loss of -6%, but which as their revenue increased in FY22, this increased to 8%. Overall, their profitability has been low over the years at around 8 to 10%, and their PAT margins are actually only around 1%. So, very poor profitability overall. I'll also be covering this in the 20 factor score. Talking about their future outlook and management commentary. So, the management is guiding 700 crore revenue and 8 crore PAT in FY26. And these levels currently stand at 340 crore revenue and 8 crore PAT. So, we'll actually have to wait and watch if the company is actually able to attain this high level of revenue increase, which they are claiming. And they also say that EBITDA margins will eventually improve as better terms are negotiated with their suppliers. As their volumes increase, they will definitely have a higher bargaining power. But as of now, they clearly do not because their margins continue to be restricted. And in the future, all the new stores which they are going to add to their existing stores are basically they want to follow a 70-30 split between their franchise owned company operated and company owned company operated stores. So all the major setup costs, etc., that can be borne by the franchise owner. And due to that, this enables to scale in an asset light model in the future. Other than this, all backend processes have been well structured now. They've also introduced a new inventory management automated system along with automated procuring, etc. So they claim that all their processes, etc., have now been placed in order. So now in the future, the growth is only going to be on increasing their revenue per store and revenue per person. And finally, after establishing its presence in Gujarat, they are making a strategic expansion to Maharashtra. So they already have a few number of stores, but they want to increase their presence in the Maharashtra region, mainly outside Mumbai in the tier 2 and tier 3 regions. Now coming to the bull case. So basically, we are going to see balanced growth with the company owned, company operated, and franchise owned, company operated split. And this will ensure their asset light scaling is in place. And their multi brand approach prevents any supplier concentration and dominance. So, issues with any one manufacturer or in case of any change in terms with a manufacturer is unlikely to interrupt their overall business. Other than that, they are focusing mainly on tier 2 and tier 3 cities. So, this limits their competition from other major established retailers, as I mentioned some names before. And this will help them gain mainly the high volume revenue from the mid-level customer segment, not the very premium segment, but the mid-level segment. And also, their rapid store scaling will improve their visibility and footfall, and this can cause more frequent customer visits and purchases. There is also in the telecom space, the growing 5G demand is basically pushing customers to upgrade from their existing non-5G compliant devices to 5G enabled devices. So this is also driving a higher demand for people to upgrade their mobile phones, which are now supporting 5G technology. Another point is that there is a rising adoption of buy now, pay later and other attractive EMI options. So now there are a lot of financing options for people who cannot make immediate purchases of these values. So this is also making premium electronics more accessible to the middle class consumers and hence directly benefiting retailers like Fonebox. And there is a growing presence of electronics on quick commerce platforms as well. So recently, we've also noticed that Zepto is now selling iPhone 16, etc. iPhone 16 delivered in 10 minutes. So this presence of electronics on quick commerce is not directly via the manufacturer. However, it takes place through these distributors. commerce platforms and not directly the manufacturing. So basically, what I'm trying to say is that Fonebox and other retail distributors can easily benefit from this growing quick commerce trend. Talking about the bear case, majorly what I saw was that there is not any major moat in the business. They do not have any product differentiation or any differentiation as such, and it is an easily replicable model. So they will definitely face a lot of competition, and there are not much entry barriers either. Their margins will constantly be under pressure, mainly, and they will be subject to variation depending on the terms of supply by the manufacturing. So this is another problem which they might face. And other than that, the company also focuses on a low margin but high volume model. And this, along with high fixed operating cost, may indicate that any reduction in their sales, any slowdown in their sales, will directly have a heavy impact on their profitability. Also, as of now, there is a lot of concentration to the state of Gujarat. So, hopefully, over the years, as the company scales, this geographic dependency on Gujarat itself should reduce. And another thing is, when people make large purchases, they usually prefer to buy from established retailers, like I mentioned, Vijay Sales, Reliance Retail, Reliance Digital, and Chroma, etc. So basically, they prefer retailers with a strong operating track record, and it may take a while for the company to establish its own brand presence like these already well established brands. And lastly, in order to establish its market presence, initially the company might also have to provide higher discounts to attract customers, which may affect its overall profitability. They had their IPO in 20 track record. So Manish Patel is the chairman and director. He holds almost 18% of the company, and Parth Desai is the director and CFO, and he has around 12% of the company. And Amit Kumar Patel is the MD, who has around 3%. And their track records are all clear. So I've given a 5. Talking about the related party transactions, there was one significant entry which I noticed that 275 crore of out of 275 crore of purchases for 24, 70 crore was made from companies over which the KMP have significant control. So that was nearly 25% of their total purchases was made from related parties. And other than this, there were also a few loans taken and repaid, but they weren't any major amounts. So I've given it a 3 for that. And talking about their board independence, 50% of their directors were independent directors. However, their family on board wasn't mentioned, but there were some repeating surnames, which I could definitely make out that they are related. However, due to non-disclosure, I couldn't make any specific conclusions from this. But these were not major concerns. So I've given a 5. So salary, they didn't draw any salary, or any of the directors didn't draw any salary in FY24. So I've given a 5. And there has been no CEO or CFO resignation or any auditor change or resignation since 2020. So I've given 5 over there as well. And the auditor has given a clear opinion, and credit opinion was not undertaken. So due to that, I've given a 3. They haven't been involved in any regulatory or legal issues. So again, I've given a 5. Closures were all in place. So I've given a 5. Now, coming to their financial health, their business concentration risk was not exactly disclosed. However, their prospectus did mention that there was no major customer concentration. And considering that they are a purely retail focused brand, they are directly dealing with a large, wide customer base, due to which customer concentration doesn't seem very evident. So I've given 5 for that. To the cash from operations, earlier the company was making almost zero profits, due to which the cash flow and hence this overall ratio was quite negative. And the reason for very positive and high operating cash flow in FY25 is the higher payables growth and falling EBITDA, due to which this cash flow operations to EBITDA ratio seems to appear higher. So for that, I've given a 0. Growth and receivables, they have a very low receivable base of around 1 to, and the only receivables which the company holds actually are the financing options which the financing companies provide to the customer. Apart from that, there are no major receivables. All the sales are made on the spots, so the company receives their money immediately, but due to which their receivables are very low. So you can see over here, receivables to revenue has consistently been less than 2.5%. So I've given a 5 for that. And talking about their inventory trends, they had negligible sales in FY21, due to which their turnover appears to be very low. So their inventory turnover was only 1 in FY21. After that, and like as their inventory position overall appears to be strong, And in FY25, the company made some improvements and corrections to their inventory management system. So they basically automated their entire inventory management and procurement system. So they expect the overall inventory position to only improve from the current levels. And overall, if you see, the inventory to revenue has been around 6 to 10%, which shouldn't be a major concern in the future either. So I've given 5 again. Talking about the cash conversion cycle, earlier it was very low. It was actually negative in FY22. But as of now, it has slightly increased only because of a slight increase in the inventory days of it has increased to around 40 days, due to which their cash conversion cycle is slightly increasing. But with the recent improvements that the company has implemented, inventory days should come down hopefully in the future, due to which the cash conversion cycle will also reduce. So for that, I've given 5. Talking about the capex, in FY22, they basically had this acquisition of these two brands, due to which we see this high capex of 5% in FY22. Other than that, they haven't invested in any major fixed assets. And they basically operate on an asset light model. And this enables them to scale without any major heavy investments. So, yeah, for that, I've given a 5. And their debt level was also very low. So I've given 5. They actually have close to zero debt. So I've given 5. And their liquidity position was a little concerning. So inventory forms a major part of their current assets. And despite a major increase in their receivables and inventory, these ratios have not improved year on year from FY24 to FY25. And this was mainly because there was an increase in other liabilities part of the balance sheet. So we need to wait for the annual report to actually look into what happened. Why did these overall other liabilities increase suddenly? And all their liquidity position did seem a little strange. I've given 0 for that. And coming to their ROCE and ROE, so they had their IPO in 2024. So before that, their equity base was very minimal, due to which the in FY23 looked very inflated. And their total asset increase was mainly because of higher inventories. So because of that, their ROCE saw a sharper fall than ROE. And because their EBIT fell year on year, but PAT still increased 33%. Yeah, that was it. Basically, that is why their ROCE fell more than their ROE. And lastly, talking about their growth, revenue growth in 2022 was mostly inorganic. So as I mentioned, their revenue scaled from 90 lakhs to 90 crores, which is why this huge revenue jump. And apart from that, their minimal gross margins, as you can see, around 8 to 10%, are mainly because they don't have much bargaining power from their suppliers. This, along with intense competition and no major product differentiation and discounts offered to increase their sales, are causing this pressure on their gross margins. And the only way I feel that the company can net margin profitable is to attain operational excellence and keep their fixed costs as low as possible. That's the only way they can keep their PAT margins higher. And so overall, if you see, their EBIT margins are 1 to 3% and PAT margins are almost 0 to 1% over the last 4 years. The low fixed asset base is what is actually causing their EBIT margin and EBITDA margin quite in line, due to no major depreciation or amortization. But in case the company goes for further capex in the future, then the added depreciation will eat into these EBITDA margins as well. So basically, what I'm trying to say is that the company is operating on very thin margins as of now and hardly making any profits. So they should definitely try to improve on that. And overall, the score is coming to 77.
A very small electronics retailing company, and they have rows of cash which would be used to propel more stores. Yeah. So from 2000 now it has corrected to 87 rupees. Looks like it was a digestible level in terms of investment. Though the management has been saying that they would target 700 crores of sales. The last March 2025 sales has been just 15%. So this raises a bit of skepticism from my end whether 700 crores of sales would be achievable from them. Anyway, both best and the worst case is drawing a number of 534. This looks more realistic than a 700 number, even with the kind of expansion they're doing. And given the 2.5% margin number and the level of 15 PE, the price comes to 115. even if it goes to 10, there is some room. It's 77, which is the current price. So current PE is at 20. Even able to not achieve 700, if they are at least able to grow by 40-50%, I think there is good room for margin of safety. However, let's take a longer time frame, because just don't go with the number or operating margin number which is low. They're just starting out, and as they grow, they would have the benefits of economies of scale, and which is when the operating level will play. So keep that in mind. Having a longer time frame, they are doing a free cash flow of crores. One thing in the investing activity which I found very strange was they were only investing 40 lakhs of fixed asset purchases every month. So I need to understand like how they are financing the store expansion, which I would probably dig much more in detail later on. So please keep that in mind. Yeah. So the free is 6, and our required rate of return is 25, and terminal growth rate of 3, and number of years is, if you're holding period, is 5. Okay, 5-year trailing multiple of 11, and then the implied growth rate has to be 21-28%, but the management is guiding for 100%. So let's see. But then last year they did a 15% growth rate, which is subpar. So you need to look at unit economics of the store, or get in touch with the management. I would definitely get in touch with the management to understand more, and that's one of the reasons why the stock is corrected.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing, and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.